They say that blockchain is a technology that's looking for a problem to solve. And we've met with founders before that are working on problems in supply chain, in the petro industry, or for real estate, in mortgages. And there's certainly use cases to be had for blockchain, but you always need to ask, do I really need blockchain to solve this problem, or do I just need a clever software package? So Bitcoin is affiliated with blockchain, and anyone who's not familiar with how Bitcoin works or what it is, I'll put a piece in our description of this video so you can check that out. And today we want to talk about why Bitcoin has been crashing and what to do next, and more importantly, what we're doing with our own Bitcoin positions. So we have a portfolio of 36 disruptive tech stocks that we've invested our money in. That total amount of that portfolio only accounts for less than 20% of the assets we have under management. And the remainder, that 80% of that, about 2% was in Bitcoin at its peak. And now it's somewhere around 1%. And we're going to talk about what our plan is with that. Now, what prompted this presentation was this. I had seen this pop up on Twitter, and I just couldn't believe how bad things are sinking in the crypto world. It seems like a lot of these people are just spend their time being influencers, and the rest of their time is spent interviewing with influencers, and it's all just a big mess. And when you look at the professionalism and the capability of these individuals, it's just remarkable how untenured some of these people can be. So here's an exchange called KuCoin, and there was some drama because, well, you can read it for yourself. A guy on Twitter named Otaru, that's all anybody knows about him, was talking to the CEO, and it's a big red flag when anybody can talk to the CEO of the company, and then the CEO posts a blog post that starts with, "Hi all, this is Johnny," and then goes on to talk about how he's speaking with this anonymous person. We try our best to answer his questions. Still, even if we explained everything, he is still blah, blah, blah. It's like a bunch of high school kids went out and decided to start playing around in capitalism. It's an absolute mess. And the deal with this is that some anonymous person on Twitter was saying that this exchange was insolvent, and the CEO is spending all his time talking with this individual. Who knows why? And the conversation is in Mandarin. So that ought to tell you something about this whole debacle, because a lot of the firms in China, the cryptocurrency firms in China, are more unregulated, if that's possible, than what you're seeing here in the States. It's all unregulated, and that itself should be a huge red flag. And you can see here on KuCoin's website, along the top there, all the red flags: buy crypto, derivatives, earn, NFT. And in regards to earn, so things have been completely blowing up in the world of crypto, and here's an example of why. So Binance, a large crypto exchange, was offering close to 19% interest for what? For nothing. So you see along the bottom there, we've highlighted no UK or EU investor protection. Well, no protection anywhere. Luna and the stable coin that it was associated with lost 99.99% of their value. They went to zero, more or less. And Twitter was full of people complaining about how they're going to kill themselves because they put their life savings in this garbage. And it completely blew up. This was no surprise at all, because prior to the crypto crash, as a matter of fact, weeks before that started, we had warned that a crash may be imminent, particularly because of a stable coin called Tether. And you can read this piece. It is shocking. Somewhere upwards of $75 billion is supposed to be tied to the US dollar and backed by assets by a number of individuals who won't be interviewed without their lawyer present and who refuse to be audited. It's probably one of the worst things that we've ever seen. And Tether is a commonly accepted, let's say, backbone of the entire crypto trading system. So it's a stable coin. And what had happened is that Luna and its associated stable coin just completely crashed. So they were not backed by US dollar. And the question is, are any of these stable coins? Well, perhaps the one offered by Coinbase is, because they provide audited statements that say it is. So it's no surprise at all that crypto has come crashing down. And now that it has, it has certainly drug Bitcoin with it. Now, one of the problems that you have with Bitcoin is when you're looking at any particular asset in the world of finance, you can find the intrinsic value of a business or asset, and there's a lot of ways to do that. So you can do comparables, or you can do discounted cash flow. This is really fun to do. So you forecast future cash flows and you build these giant models in Excels, and you can value businesses. We did this in business school, and we broke out into teams, and then it was funny to see what valuation everybody came up with. But what was cool is if you did your valuation properly, sometimes you could get close to what the actual stock price was. And that was, interesting to see that the market was valuing an asset the same that you were. Now, valuing Bitcoin is impossible. So even if we look at some of the most sophisticated products out there, like options, so these are very speculative, but they still have a valuation associated with them. Here's the Black-Scholes model, and anybody who studied finance would have worked these calculations by hand to figure this stuff out. You can see here, you take the security price, strike price, expiration, interest rate, and volatility, which is its own beast to conquer, and you figure out the price of an option. And very sophisticated computing platforms can do this on the fly and capture arbitrage opportunities, etc. But when it comes to Bitcoin, we have no way of valuing it. So we like to keep things simple. When we look at a company, we often take the market capitalization, divide that by annualized revenues, and that gives us this simple valuation ratio. With Bitcoin, the only way to value it is by greater fool theory, meaning it's only worth as much as somebody is willing to pay you for it. And essentially, it's drawn the attention of a lot of speculators, many retail, along with institutional interest. And it's been impossible to value Bitcoin because there's no intrinsic value associated. So we're left with looking at historical data. So because it doesn't have a value and it's largely speculation driving the price, there's no price support for Bitcoin. So there's no point where a private equity firm might step in and buy Bitcoin because it represents so much value. What you have are humans trading against algorithms, and there's absolutely no regulation governing the entire thing. And what you have to remember when you think about trading is that back in the day, before we had artificial intelligence algorithms, there were very smart people, what they call big swinging dicks on Wall Street. And you see here, this is an article in 2008, the end of the BSD, a Wall Street icon falls. And indeed, that was when most prop trading departments in investment banks started disappearing in favor of a handful of quants, or they would spin them out to hedge funds. And now all of that would be run by black box algorithms that try to capture alpha at the blink of an eye. So you can be sure that whenever there's money, you have hedge funds stepping in there and fleecing naive retail investors who are subject to human emotion. So the question is, can you even invest in Bitcoin? Well, can you speculate on Bitcoin or invest? You might be able to invest if you read ARK Invest's bull thesis on Bitcoin, which is quite compelling. And I'll put a link to that in our video here, and you can read our interpretation of that bull thesis, which is credible, and also as an alternative asset class. So we look to hold around, let's say, 7 to 10% of our assets maximum in alternatives, which provide diversification. What's an alternative? Well, the ones we're holding are gold, wine, art, and Bitcoin. Others would be private equity, real estate, hedge funds, startups, etc. So there's this term in the Bitcoin community or the crypto community of hodling, which is essentially to say holding. And the question is, when you're holding Bitcoin, things become very difficult when it's volatile, and Bitcoin has been extremely volatile. So you can see a lot of money, a lot of paper wealth amassed, and then you can see it disappear overnight. And what you're able to do when you have a speculative asset like this is start establishing what's called patterns of predictability. So they call this technical analysis. And back in the days of the BSD, this was commonly used because patterns would repeat themselves. And this was taken from a very enjoyable website called Long and Short Capital, which was run by some BSDs that were taking the piss out of the entire investment banking world. And it should have been a lot more popular than it was. But here they're showing the Bactrian double hump camel and making fun of technical analysis here. So technical analysis has merits, but these days it doesn't make a whole lot of sense because you have a lot of algorithms that you're running against, and things have gotten a lot more sophisticated. But we can keep it simple here and look at drawdowns for Bitcoin. This is very useful. You can see that in 2011, a drawdown is from the peak to the trough. So in 2011, when Bitcoin fell significantly from peak to trough there, that was a 93% fall. And then the next big fall was in 2013, 2014. You can see that from peak to trough, that was 83%. And then more recently, 2018, peak to trough, 82%. And the idea here is that volatility is decreasing over time, which is what ARK tells us will happen. And that means we would expect volatility, or let's say we would expect the price today, because we're heading down into the trough, to not exceed 82%. So here's those numbers spelled out. And what we're looking for is the 2021, and you might say it's 2022 period, which ends after XX days and an XX% drawdown. Well, where are we at now when it comes to the percent drawdown? Well, we have a high water mark for Bitcoin of $69,000. That's the highest price that it reached. Today, it trades around $21,000. The lowest that it went after hitting that $69,000 mark so far is just above 17,250, about a 75% drawdown. So what you'll see now are a lot of people talking on, a lot of pundits saying, well, it should see a drawdown of 80%. The idea being that it's going to be closer to what the drawdown was the last time, but not that quite that far. And others are saying, well, it actually will exceed all the previous drawdowns because we're in a bear market. And that remains to be seen. If you believe that Bitcoin is decreasing in volatility over time, which is part of ARK's thesis, then perhaps the 75% drawdown that we saw is the maximum we'll see this time. And now it's heading to establish new highs. Who knows? Because there's no way to tell. It's all a bunch of speculation. But one thing has changed here, and that is the entire crypto world is melting down. And funny how everybody talks about all the money being made, but when things start melting down, you don't hear a whole lot about it. Well, had a firm called BlockFi. They had $1.8 billion in loans with no collateral, and a crypto billionaire stepped in to provide them with a lifeline. And he also bought the assets of a bankrupt company, crypto lender called Voyager. And this same individual was interviewed in Forbes, and he claims that some crypto exchanges are secretly insolvent. And what that means is they have no assets to cover their obligations. And if they're opening new accounts, they're nothing but Ponzi schemes. And some always were Ponzi schemes. And now you're starting to see firms go under. So Singapore-based Three Arrows Capital, their founders disappeared because they were a leveraged crypto trading firm with 200 million exposure to Luna, and they were nearly insolvent. The founders recently came out of hiding to answer questions. It's just an absolute joke. You have crypto firms like CoinFlex, Babel Finance, others. KuCoin was being accused of not having liquidity, and that remains to be seen. But these firms, you'll see, have been blocking withdrawals because of a lack of liquidity. And that's causing the crypto equivalent of a bank run. And they'll send out messages, oh, we're having some technical difficulties. We can't offer any withdrawals right now. It's just a mess. One of the largest crypto lenders in the world, Celsius Network, filed for bankruptcy weeks ago when all their clients got scared and lost their diamond hands. And before they had halted all withdrawals last month, Celsius had accumulated more than 20 billion in assets by giving depositors interest rates as high as 18%. It's just a big Ponzi scheme. And we've warned about all this ever since it started manifesting itself, because there's no regulation. And that's supposed to be one of the selling points of this Web 3.0 world. That has created a lot of scams, a lot of problems. You'll see $300, $400, $500 million just disappear from a startup, and everybody will just throw their hands up in the air and say, oh, well, and move on to the next one. It's just completely irresponsible. So when we look at our original thesis for Bitcoin, remember, we wanted an alternative asset class. Well, the problem is that correlation for Bitcoin started increasing in April to an all-time high of 0.7. So it was pretty correlated to the NASDAQ. But then when everything crapped out, the correlation fell again. So if you'd measured correlation from now until the original time of Bitcoin, of course, it's not correlated, but there's a concern there that it may not be as uncorrelated as everyone thinks. Now, when it comes to ARK's thesis, that remains intact, as does ARK. ARK has around 14 billion in assets. They had net inflows this year, say last year, I believe. I'm not sure about this year, but their institutional investors still have faith. So ARK has gone nowhere. And what has changed since we originally invested in Bitcoin is the systemic risk, which means all our concerns around stablecoins and whatnot are indeed merited. And it's certainly not over. And we'll see what the fallout ends up being. So here on the right, I've put up a chart that shows the 5 Bitcoin mining firms in our tech stock catalog. We have a catalog of 436 tech stocks that we've covered over the years. And I pulled the Bitcoin miners out of there. Here's their year-to-date returns. Bitcoin has seen a year-to-date return of 52%. So as we said, the leverage works both ways. And some of these firms may be in a world of hurt because there was a lot of assumptions that Bitcoin just would never fall. That's a concern in itself. So in regards to our own Bitcoin position, we purchased Bitcoin. I believe we started buying small amounts in the 24 or 2500 range. We had actually been accumulating from a affiliate program that we had, and that was, I believe, with Coinbase. And our current position accounts for about 1% of our total assets under management, with a cost basis of $7,815 per coin. Now, over the, let's say, I think probably past several years, we've reduced our risk by recouping our entire investment with a 7% return at an average selling price of $41,907. So to get these numbers, I simply went to Coinbase, I extracted all transactions, and I did all the numbers real quick. So what's happening here is that we're playing with the house's money with our remaining position, but we need to be careful and not fall prey to the house money effect, which is starting to take on more risk because you are theoretically playing with someone else's money. Now, if we look at the $69,000 Bitcoin watermark and the drawdowns that can happen, you can see here that at the most recent drawdown of 75%, if we were to sell there, we'd still be realizing 121% profit based on our cost basis. And you can see the various numbers here. So the question is, at what levels do we start becoming concerned? Well, one could argue that if Bitcoin starts falling again and it exceeds the 83% watermark that it saw the last drawdown, that's a big concern, because we've been told that volatility for Bitcoin is decreasing over time, and that would mean that's not the case. So you would certainly be quite concerned if that happened. And what Bitcoin investors need to do is to set their own charts and their own rules around where they plan to exit, make some objective rules, and stick with them, because you're dealing with a very speculative asset class here that has no intrinsic value. So just to conclude, as we've said in the past, Web 3.0, crypto, ICOs, NFTs, these are a scam-ridden house of cards that should be avoided like the plague. And the safest, quote unquote, exposure has traditionally been Bitcoin and Ethereum. We wrote about why we believe Ethereum should be avoided for now. I'll put the link in the description. And since there's no intrinsic value associated with any of these coins, you need to set objective rules and stick with them, similar to how you would engage in trading. And as we always say, stay cautiously optimistic. That means absolutely nothing, but it's a fun thing to say because it sounds like it has more substance than it does. And I just wanted to part with this last statement. The speculators' deadly enemies are ignorance, greed, fear, and hope. This was taken from Reminiscences of a Stock Operator, which is perhaps one of the best classics when it comes to reading in finance, that you ought to give it a read because it was written in the 1920s, and still is relevant today. So please put your comments in the comment section. Be sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.